Welcome to Wrap-Ups 101, a fun, informative crash course on wrap-up insurance programs. Before we get into wrap-up insurance programs, let's take a look at the traditional approach used to insure construction projects. At the top of the diagram is the developer or owner. They are carrying their own insurance. Below them is the general contractor or construction manager with their own insurance. Below the GC are the prime trade contractors, and below them their subcontractors, all carrying their own insurance. As you can imagine, all of these different coverages and coverage providers create the potential to cause major issues. Some contractors will have inadequate limits, gaps in coverage, or there may be some contractors without coverage at all. Also, because there are so many insurance companies covering one project, every claim has a potential of cross-litigation, which we will explain later in the presentation. But we're here to talk about wrap-up insurance programs, so let's get into that. Here's a brief technical description of a wrap-up insurance program. It is a risk management and financial product that provides greater control over construction exposures for a large-scale construction project or projects, which are usually over $100 million in construction value. The sponsor, which could include the owner, developer, or general contractor of the program, purchases an insurance program, also known as a wrap-up. These programs include insurance coverage, loss control, and claims management services on behalf of themselves, the construction manager, general contractor, and all the subcontractors. In turn, the subcontractors are required to remove the cost of insurance from their contracts or bids. This is where the project cost savings can be realized. The overall result is a more efficient and cost-effective risk management program covering the project. To contrast the diagram we saw 2 slides earlier of the traditional approach to insurance, we have a similar diagram for a project covered under a wrap-up insurance program. As you can see, instead of hundreds of different coverages, everyone is covered under one insurance policy. Just by looking at this, you can tell that things under a wrap-up are much simpler than the traditional approach to insurance. There is no longer a guessing game about which coverages each contractor has. A traditional wrap-up will provide workers' comp, general liability, and excess liability coverage. However, GL-only wrap-ups are also an option. These provide only general liability and excess liability coverage. Dirty wraps can also be purchased, which provide pollution liability coverage. Wrap-ups can also include other coverages like builder's risk and professional liability. In fact, there is even a wrap-up product for bonding called subcontractor default. Just about any coverage associated with large construction projects can be wrapped up. Here is a typical structure for a wrap-up insurance program. Wrap-ups will almost always utilize large deductibles. In our example, it is $250,000. Often the wrap-up will have different deductibles for workers' compensation and general liability coverage. Above the deductibles are the primary insurer, and above them are the excess carriers. The total excess coverage limits can vary greatly depending on the project or projects, or if it is a rolling program. Not every party involved in the project will actually enroll into the wrap-up. The whole point of a wrap-up is to cover activities on the project site, so supply-only or delivery-only contractors will often be excluded. Some carriers may decide to exclude certain scopes of work, such as asbestos removal, EFIS, and lead abatement. Also, some trades will be excluded because of union contracts, such as Local 3 electrical workers in New York. Typically, a wrap-up is purchased by either the project owner or a construction manager or general contractor. If purchased by the owner, it is referred to as an OSIP, or Owner-Controlled Insurance Program. A maintenance wrap can also be purchased by facility owners to cover continuous ongoing construction. If the wrap-up has been purchased by the GC or construction manager, it would be referred to as a CSIP, or Contractor-Controlled Insurance Program. These wrap-ups can be purchased to provide coverage to a single project site or multiple project site called a rolling CSIP. Now we're going to look at the benefits of a wrap-up. First is the basic concept of buying bulk. When purchasing bubblegum, you can realize great savings on a per-piece basis when you buy an entire bucket of bubblegum versus just one piece. The same concept applies for wrap-up insurance programs. The sponsor of a wrap-up is getting a huge discount on the insurance compared to what the individual contractors are paying because they bought a lot of coverage at one time. When so much is purchased at once, economies of scale are realized for the wrap-up insurer, and these savings are passed on to the sponsor. Here's an example of how the insurance costs are removed from the subcontracts. The example on the left is a contractor bidding on a normal non-wrap-up job. As you can see, they included a $3,000 charge for insurance. On your right, the contractor is on a job which is covered by a wrap-up. Therefore, they remove the $3,000 from their contract for insurance. Not only is the $3,000 removed, but the associated overhead and profit markup of $750 is removed also. This creates a total of $3,750 removed from the contract. There are two ways to remove this cost for insurance from contracts. The first way is the deduct method. The contractor bids a job with all insurance costs included. Once the bid is accepted, the insurance costs will be removed via deductive change order. This deduct may be adjusted when the contractor is complete, based on their reported payroll by the contractor. Next is the alternate add method. Here, a contractor bids the job net of insurance or with no insurance costs in their bid. Here is an example of how a deduct bid compares to an alternate add bid. The deduct bid on the left still includes the cost for insurance. The alternate add bid on the right has the insurance costs already removed from the bid. This diagram illustrates how wrap-ups save money. The red line on top represents the insurance credits removed from the contractor's bids, otherwise referred to as the traditional cost for insurance. In other words, this is the amount that the sponsor would have paid had a wrap-up not been utilized. The green diagonal line represents what the sponsor will pay under the wrap-up. The lowest point on the green line indicates the fixed cost amount of the program. Fixed costs include all the premiums and fees that the sponsor will pay for the wrap-up with zero claims. Each time a claim occurs, the sponsor pays, and each time the sponsor pays, they creep further and further up the green line. As more claims are paid and the gray dot moves up the green line, the amount of profit available to the sponsor decreases. Thus, the more variance between the contractor credits and the fixed costs, the more dollars available to pay claims. In turn, the less money spent on claims means the more money kept as profit. Bottom line, how much do wrap-ups save? Usually a wrap-up will save the sponsor around 1% of the total construction value of a project. This may not seem like much. However, if this was a $200 million job, the sponsor could have saved $2 million overall by utilizing a wrap-up insurance program. Along with project cost savings, there are many other benefits of a wrap-up program. These include safety control. Wrap-up insurers will provide special safety reps to observe the project and offer safety guidelines to follow, creating a safer than usual project. Also, the sponsor will yield much more control over their project. All the claims will come to one insurance company and to the sponsor of the wrap-up. Thus, the sponsor will always know about incidents and they have the ultimate power when settling these claims. Most wrap-up programs have very high limits, $50 to $200 million and more. If a major disaster happens on a project not covered by a wrap-up, the responsible contractor may not have adequate limits to cover the damage. Contractors usually carry around $1 to $5 million in total coverage. Thus, the owner or general contractor may be on the line for the difference. However, if the project is covered by a wrap-up, the limit should be sufficient to cover any incident. Cross-litigation is a major problem with the traditional approach to insurance for large construction projects. For example, let's say that my employee gets hurt on the job. I report this to my insurance carrier, but it's actually the plumber's fault that he got hurt. My insurance carrier then sues his insurance carrier. They in turn sue the insurance carrier of the guy that hired the plumber, who decides that it is the fault of the prime contractor, then the general contractor, then the owner. All the while, the claimant is not being reimbursed for his medical bills, causing him additional financial stress. In a wrap-up, there's only one carrier, so the wrap-up carrier services the claim and your contractor gets back to work. Here's a quick recap of the benefits of a wrap-up insurance program versus the traditional approach to insurance. As you can see, wrap-up programs can provide immense advantages over traditional approaches. Thanks for taking the time to view our presentation. If you have any questions, check out our website, give us a call, or email.